Hi, Joe Kehrig with the Kehrig Real Estate Team, and this week we're going to talk about the Fed, the forecast, and the future. First off, how does a Fed discount rate and the 10-year Treasury affect interest rates? So I'm going to show you. First off, they look at inflation, because what happens if inflation is high, the Fed will keep rates up to tamp down inflation. When basically the economy goes sideways and inflation, no one's spending money, then they lower the rates. So in this case, you can see the inflation remains elevated. The Fed target rate is 2%. And you can see at one point in 2022, it was 5.3. It's all the way down to 2.9, but their target rate is 2.0. So they're really keeping an eye on that, and that will keep rates up a little bit. But here's the thing, the 10-year Treasury, as you can look at the 10-year Treasury and the interest rates, they almost match each other perfectly. Right now, there's a 2.59 spread, but again, it's narrowed over the last few years, where right now it's only, the average spread was 2.59, now it's about 2.10. That's where we've seen interest rates come down a little bit. And you can see what determines the mortgage rate. You look at basically the 10-year Treasury and the spread, 2.10, and that gives you the 6.3 interest rate, where we are right now. So that's how interest rates come about. It's more focused on the 10-year Treasury, but the 10-year Treasury is affected by the bond market and the Fed rate also. Now, the 10-year Treasury yield forecasts to come down. It just hit. You can see right now it's just obviously right at 4. It just dipped to 3.9, and you can see it expect to come down and down. So as the 10-year Treasury come down, interest rates should come down, except the Fed rate has been keeping the interest rate artificially high. Look at this graph. You got 4.20 and you have 2.1, so the mortgage rate is 6.3. Well, basically the average over the years of the spread was 1.76. So if we were still at 1.76, where we've been over the last few decades, mortgage rates would be under 6%. The reason it's a little bit higher, again, because the Fed is keeping things propped up a little bit, because they're a little bit afraid of the inflation still and lowering the rates, but expect it to come down. You can see how do rates affect the buyers. Well, you can see the lower the rate, the stronger the buyer demand. And so you can see when it was up around 7.5, the buyer demand was weak. And then from 6.5 to 7, it's limited. Then it gets down to under 6.5, and the buyer demand is good. Look what happens when it goes under 6%. It becomes strong. The buyer demand becomes strong. So again, when it gets under that 6%, wait till you see the buyers come out of the woodwork. Unemployment is another thing they still look at, because if people are employed, then they're going to be spending money and they're afraid of inflation going up. If unemployment is high, like you can see it was in 2020 during COVID, then they'll lower the rates. And it's been holding pretty steady, 4.3 adjusted. And you look all the way from May of 2022, the last 3 years, and it has stayed pretty steady. So unemployment staying pretty steady, obviously, which helps. It's just a solid. The job numbers have been, kind of flat but average. The number of home sales continue to be higher. And when we say higher, you can see that this year it's bumped up over 1 million homes nationwide. Well, you know what? That's where we were in 2018 and 19. So when we talk about a normal market, that's kind of where we're at. We're kind of a normal market. If the home shows nice and it's priced right, it's going to sell. If it's priced too high or it doesn't show nice, it's not going to sell. So that's what we consider a normal market. I've been doing this for 48 years, and that's about as normal as you get, 2018 and 19. And the inventory right now is about where we were in 2018 and 19. So we're more in a normal market. Home sales are expected to rise. Now, this is with the total home sales, including new homes. And you can see it's 4.7, 4.8. They're expecting to go 5.2. The resale market has been below 4 million. Which again, it hasn't been that low in 30 years ago. And 30 years ago, we have 30 million more people, so again, there's not a lot of sales going on. That's why you're seeing inventory rising a little bit. home price growth is moderating because as you have, it's everything supply and demand. So as you have more supply, obviously the demand is tougher. So you can see home price growth is moderating all the way from February 24. You can see how it's down to 2.3%, again, nationwide. Where are the expectations as far as home prices? The Fannie Mae home price is, you can see what the actual is a blue, most pessimistic, and then obviously the panel wide is home price change from 2025 to 2029, 15%, and the most optimistic is up to 25%. So again, the one thing you'll notice with this, even on the most pessimistic quartile, they don't see home prices going down. You haven't seen anything here that no one's expecting prices to go up. We might just see inflationary appreciation. Inflation is 4%, home prices go up 4%. So how's that affecting our market here? Well, you see in the San Ramon, inventory's coming down a little bit, but, which is good. Remember, home prices, the number of homes on the market peaked in July. And then it will go down and down and down and down. That's why it's not a bad time to put your home on the market. We talked about having 2 bites of the apple. If you're ready to go, put it on the market now. If it doesn't sell, then you can put it back on the market in February. A lot of people are asking, should we wait and put it on the market in February? Well, with the lack of inventory, with inventory going down, it might not be a bad thing if you're ready to take 2 bites of the apple. Try it now. If it doesn't sell, then you can always put it back on in February. You can see the pendings are staying pretty solid. Danville market, again, inventory is going down a little bit. The pendings are going up. So again, if you're a seller thinking about potentially going on the market, now might be the time. Alamo market, you actually see, the inventory went up and pendings went down. But again, you look at the week before, actives went down and pendings went up. So Alamo, because there's not a lot of homes on the market, there's a lot of volatility that will go back and forth with that market. Dublin is almost stayed about the same, except you can see pendings are staying pretty solid. So when you look at the sold price to list price, in Alamo, it's 104%, but that's because you had one home that came on the market for about 1.7, and it was a teardown, Westside Alamo, and it ended up selling for 2.1. So it kind of threw things off a little bit. But you can see everything else, 97, 98%. Overall, things are selling 97, 99% of the ones that are selling. So if you're priced right, you show right, you're going to get pretty much near asking price. But again, the market's different no matter what neighborhood, individual homes. But if you want to sit down and decide, hey, Joe, if I want to get the best price for my home, how do I do it? What do I have to do to my home, where I should be priced? Because those are the 2 most important things. We'll sit down, do a walkthrough with you and kind of say, hey, if you want to spend $20,000 here, you can probably get $60,000 in return, and kind of give you an idea. And now might be a perfect time to do some of that work and hit the market in February where we have more buyers out there. But if you want to sit down and chat a little bit about it, my cell number, 925-487-6838, or drop me an email, joe@kehrigteam.com, or visit our website to learn more about the Kehrig team, www.kehrigteam.com. Tune in next week. We have a lot of changes coming up. The Fed is obviously, they expect them maybe to lower the Fed rate a little bit. So stay tuned and you'll probably see a few changes.